Have you ever felt unsure how to evaluate a syndication or wondered if you're ever truly protected as an LP? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're diving into the legal side of real estate syndications with actionable insights straight from a top industry attorney. I'm your host, Pascal Wagner, and today we're joined by Mauricio Rauld, a premier syndication attorney with over 25 years experience. Mauricio is the founder of Platinum Legal Consulting.
That's right.
And a trusted advisor to top GPs, including names like Ken McElroy and Robert Kiyosaki. Do I have
I don't
that
represent
right?
Robert, but Ken McElroy and most of the advisors I represent. I know Robert now, but Robert doesn't raise capital directly, no.
Yeah.
Robert's an LP.
Is he?
Yeah.
Oh, I'd want to hear more about that. So if you've ever wondered how to spot red flags, understand offering documents, or ensure your capital is protected, this episode is packed with must-know advice for passive investors. So with that, let's dive in. Welcome, Mauricio.
Well, thanks for having me, man. I'm super excited. Great to be here in sunny Miami, Florida in the middle of winter, so it's awesome.
Yeah, happy to have you here. So just kind of like kick us off, I'd love to start out with, you were just here in town for a conference.
Yes.
I'd love for you to kind of touch on that a little bit.
Yeah, so I was here for my buddy Brad Blazer, who's the $2 billion man. He throws a couple conferences throughout the year, and he teaches his students how to raise capital for either specific syndications or for funds. And it's not just real estate. I'm usually in the real estate world, but there's a lot of people who just are looking to buy other businesses or just operating other business. I've done a couple deals with like data centers, for example. That's a kind of an up and coming thing. So he does this, he does it in Miami once a year, and it's a good excuse for me to fly out to Miami. I've got a lot of good friends here, and now I know I've got you here, so maybe we'll do this once a year.
I would love to do this more. Yeah. Awesome. So, and I know that you also, maybe a month ago, just recently went to the Multi-Housing National Conference in Vegas?
No, you know what? I did not go to the multifamily, the multi-housing, National Multi-Housing Conference, but I have a lot of my clients who went out there, and the vibe that came out of there, the communications I was talking, it prompted me to put out quite a bit of content about the theme, the persist until 26 theme that I believe was present at that event. And so I've just been interested in talking to my clients whether they agree with that. It used to be, remember, survive until 25. Well, here we are in 25. Now the rumor coming out of that conference was it's more like, there's still a lot of loans that need to clear. There's still a lot of stuff that people have been kicking down the can. So the theme there was we just need to hang on for a little bit longer, persist until 26. And I thought that was an interesting development that came out of that conference. So I've been doing quite a bit of content around that.
So just while we're on that topic, this show's oriented around LP and LPs that are, looking to make safe, low risk bets at this time. Maybe some people are still tied up in some deals. Yeah. Tell us a little bit more about, maybe operators that are hanging on, trends that you're seeing across clients.
Yeah, so what happened, so I'll tell you from the GP side, because obviously it affects the LP side. So what happened back in 2020, 21, 22, we were sort of at the height and the peak of multifamily, right? Valuations were at the high. And what was happening was, especially after COVID, that the valuations of the properties were skyrocketing, but the rents that the operators were able to charge weren't keeping up with that valuation. And so the ratio, right, of how much rent they could collect versus how much the property worth wasn't penciling out for the lender. So there's something called the debt coverage ratio that you have to come up with, not to get technical, but essentially what it meant was that the lenders weren't willing to lend the usual 80% of the purchase price or 75 or 80. They were lending more like 60%. Which is problematic. And so what a lot of operators started doing was going to these floating rate products, right, which were obviously cheaper. So instead of, not only were they cheaper, but they were giving 80, 90% loans, right? So the leverage was back and they loved it. The challenge was they're just bridge loans, right? They only last for 3 years. They were what we call 3-1-1. So 3 years and then maybe a couple of extensions. But after 3 years, the plan is you've got to then refinance and go into a conventional longer term. Well, everybody gets insurance, and there's things called rate caps. Again, not to get super technical, but essentially there's insurance that you can buy just in case the rate goes super high really fast. There's a cap, right? Well, as you guys know, interest rates over the last 2 years, or at least from 21 to 23 or 24, just skyrocketed and went much, not only did they go higher, but they went higher much faster than most people anticipated. And so a lot of the operators got caught where they not only got to that cap, maybe they got a loan at 4%. Now the interest rate went to 6%, then went to 7%, then went to 8%. So now that those loans are expiring, the valuations haven't kept going up. The valuations, in fact, are coming down. So they have to refinance the loan because they can't support the project at a 9% interest rate or an 8% interest rate, whatever the reset is. So they have to either refinance the property or they need to sell. And the problem is the valuations aren't there anymore. So you can't just refinance. You would lose money in that. So that's the issue that people are having. But what I've talked to lenders about is that the lenders, based on their experience from 2008, they don't really want these properties back. I mean, their remedy would be to go foreclose. Hey, you can't pay me the loan. You don't have enough rents coming in. I'm going to foreclose. They don't want to foreclose. They don't want the properties. It's just a nightmare from an administrative standpoint. So they've been kind of what we've been talking about. So they've been extending and pretending. So they're coming up with modifications. They're trying to work with the operators in the short term, maybe extending and giving them another year. But those have strings attached too. It's like, I'll extend it for another year, but you've got to put in some money in escrow. You've got to cover the insurance. I mean, it's a mess, right? But those haven't cleared. All those operators that were in trouble last year, we figured, hey, by this time, those would have all been forced to sell or forced to refinance, or they would have been kind of cleared out of the market. And they haven't been, because the lenders have been willing to extend those loans, modify the loans, maybe whatever they're behind, they would just tack it onto the end of the loan, like all these creative things. As long as a property's kind of performing with the hopes, really, it's obviously a hope strategy that interest rates would come down and that would allow them to maybe refinance. Obviously, the Fed has been lowering rates, but the mortgage rates have not necessarily come down over the last 6 months or a year. So there's just a lot of stuff that needs to clear, and it hasn't cleared yet. What we really need is for the operators who just didn't do well, and they need to just sell or refinance and just take the loss. Unfortunately, it does mean loss for LPs. I mean, what's unfortunate, I'll just be honest with you, I mean, right now there's a lot of properties out there where the LPs, they've already lost their money. They don't realize it. They haven't been told that, but the property's down. If the property's down 20%, that's the LP equity. Like, the equity's gone. And now the question is the property worth even as much as the loan? I mean, that's what the stage we're at. Are the lenders going to start taking a haircut? But for most of these projects that were in 2021, 2022, unfortunately, the LP equity is already gone. They just don't either know it or it hasn't really materialized yet. But until all of that gets cleared, until those operators are able to sell at a loss or break even or whatever arrangement they come in and get those off the books, we're not going to be able to sort of start that new cycle that everybody's really waiting for. So we're kind of at the bottom, I think, of the market. But until that clears, we're not going to be able to get to the next phase, which is now, okay, those are clear. Now we've got good properties with good loan products and good markets, and now we're on to the next phase.
I think there's something that I'm even just picking up in this conversation, and I've been told this early in my career, which is understanding the debt. If you're an LP investor, you need to understand your operator's biggest partner. And that biggest partner is the debt partner. Yeah. They're arguably, and maybe even understanding the debt is more important, I don't know, more important, but then the deal, then maybe that being the deal, because that is what dictates a lot of this. I don't think I appreciated and understood that banks were only lending. I knew that banks were lending less, like 60, 65. I got a loan during that period, and my loans were at 65%.
Right.
And so I felt that. I didn't understand or appreciate that operators took bridge loans that would give them the higher leverage in order to make that. And I imagine a lot of LPs also got wrecked or didn't understand that as well.
For sure.
Do you have comments around that?
Yeah, I do. I mean, that's definitely the loan product, or what I call the loan product, is an integral, critical piece of the deal itself. And so as a syndication attorney, or as a former syndication attorney, that's a big disclosure. Like, you need to, operators through their attorneys will disclose everything about the loan product. So it should be in there, hopefully in the private placement memorandum on the disclosure document. It might just not be, flashing red. It's going to be somewhere buried in the risk disclosures. But yeah, that's very important, because what you want to do as an LP, this is very, very important, is you want to understand what the assumptions are that the GP is making, right? And one of those assumptions in this particular context was, hey, I'm going to get this short-term loan. It's a 3-year loan. And at the end of 3 years, I am going to either refinance or sell. That was the assumption that they were making. So then the question becomes, okay, what happens if that does not occur? What's plan B? What happens if I can't refinance after 3 years? What happens if I can sell? What are the consequences? And you have to ask those difficult questions of the GP and get the answers. And then as an LP, you have to just make a decision. I mean, there's always going to be risk. And so you just have to be comfortable. Okay, I've understood as long as you understand all the risks and you understand all the benefits, and then you do your way and figure out, hey, is this worth it or not? Because I think where a lot of LPs got carried away is that they were viewing these returns that they were seeing on the pieces of paper as almost guaranteed. It's an ATM machine, they're just coming. And one of the most important concepts I think that LPs need to understand is this concept of a risk-adjusted return, right? Just because one person is giving you a 20% return and the other person is giving you an 8% return, that doesn't mean the risk-adjusted is the same. So you have to account for the fact that if you make 10 investments, maybe 6 of them will do well, 2 of them will kind of break even, and 2 of them will lose. And so what does that look like in the long term? That's your risk-adjusted return. And so just because you see flashy numbers, and let's be honest, and I've said this for many, many years, and GPs don't necessarily like this, but I mean, the pro formas, I mean, they're just made up. They're projections, right? You don't know what's going to happen in 5 years. Everybody's like, oh, we're going to hold this thing for 5 years, and then the cap rate's going to be this, and the rent's going to be like, you don't know. I mean, you can make some pretty good estimates on the rents maybe, because if you're in a strong market and you can say, hey, let's be conservative, let's just even assume 2% increases or whatever. But an exit cap, like meaning, what is it going to be worth in 5 years? You just don't know all the things that can happen, whether it's a recession, whether it's interest rates going crazy, whether it's just whatever. It could be a black swan. I mean, like, you have no idea. And so that's why I really like these things called sensitivity analysis, which is I always encourage my clients to do, which is instead of telling the investors, hey, we think it's going to be worth this cap rate, like it's going to be a 5 cap, which means it's going to be worth X. I would say, look, if it's a 5 cap, this is what it looks like. If it's a 5.5 cap, this is what it looked like. If it's a 4.5 cap, and give them a range. So number one, they understand it's not guaranteed and we don't know, but also it just gives them a nice little range. But yeah, risk-adjusted return, I think more people are starting to understand that, yeah, these things are not ATM machines. They don't necessarily distribute like clockwork every quarter. Sometimes you stop distributing.
ATMs.
But there's just always this assumption like, hey, the projections are 12%. I'm just going to get 12% every year, and that's just not how it works.
Yeah, I think this concept of a risk-adjusted return is a difficult concept for even me to understand. How would you explain? Like, I'm an investor looking at deal. I look at deals.
Yeah.
I'm investing in deals. How would you explain risk-adjusted return to me?
It's all about the assumptions, right? So you're comparing multiple deals. So let's say you're comparing 2 deals. So one deal is saying I'm going to return 20%, and one person is saying I'm going to return 12%. Well, now I have to look at what the assumptions are. How are they getting to that 20%, and how are they getting 12%? And I have to make, and it's a skill. That's why LP investing is not some easy, like there are professional LPs. Like, this is a professional, you've got to know what you're doing. You can't just be like, hey, I'm just going to throw money at you. You have to evaluate and say, how likely do I believe that this person's actually going to be able to do what he or she says to do, and all the assumptions they're making are going to become true. And if I think it's a slam dunk 100% of the time they're going to do it, then that's great. But if I think it's a 50-50, for example, chance, and they're offering me a 20% return, I'm going to assume it's a 10% return, because there's a 50% chance it's going to go to 0, and a 50% chance it's going to go to 20. That averages out over time. It's going to average out over 10. Now, the problem is that's the average, right? It's like I used to play a lot of poker, and it's like in any particular hand, who knows? I mean, you could really get screwed. But over time, if you play 1,000 hands or 100,000 hands, that's going to work. Same thing with investing, which is why I think the more successful LPs are just literally in 20, 30 syndications, because they, if 1 or 2 go bad, or they lose all their money in 1 or 2, they'll make it up on the 2 that over index, and then, it kind of all averages out. But that average is what I would look at as sort of the overall risk-adjusted return as an LP investor. But it just has to do with the assumptions, like how likely are they going to, do I believe that they're going to be able to, whatever assumption they made, hey, interest rates are, like, for example, one I could be doing a deal and my assumption could be that interest rates will go down by 2% in the next 2 years. That's my assumption. Now you have to come and say, I don't know, I think they're going to go up. So if you think they're going to go up and I think they're going to go down, then this really high risk adjusted return. But if you think they're going to go down to 0, then I'm almost conservative compared to you. So you always have to compare what you believe is going to happen and then compare that to the assumptions that the GPs are making.
And maybe let's say top 3 or top 5 assumptions to check. It's probably interest rates, and what do we think interest rates, purchasing environment is going to look like when they go to sell. I would imagine second one might be exit cap rate, what the market is willing to pay for. And then
rent projections. So, hey, I think I'm going to increase rents after I remodel everything. I'm going to increase rates 20%. Okay,
Right,
well, do
right.
you think you're going to be it? What makes you think you're going to get? What if you get 10%? What if you can't raise the rents? What if there's a recession? What if you so increasing rent, and there's two parts of that. One is the initial bump, which you should get because you're adding value to the property. So once you put that better product on the market, you should get something close to market. But what is market and how are they confirming that? And then once it's rented, what's the sort of normal market? Is it 2%, 3%, 5%, 1%? So that's one assumption I would look at very, very closely because that's key. The other component is occupancy, obviously. Like if I'm buying it at a 80% occupancy and my assumption is I'm going to sell it when it's at 92% occupancy, well, okay, how likely with the amount of rent they're charging, how likely am I going to get to 92%? So those for sure, and the cap rate, those three will determine.
And then I'm thinking two more. There's probably expense management. So like CapEx,
right.
How much is it like, hey, we're going to set aside this amount of money to redo the roof. Is that enough money? And then I imagine the last thing, which is probably more relevant in recent years, which is insurance and taxes. Right,
100% insurance. I'll tell you a quick story. So one of the people I advise is Ken McElroy, who's a Rich Dad Kiyosaki advisor, and he's one of the top. In my book, he's one of the top syndicators around, right? And he started his career as a property manager. So he knows property management inside and out. I mean, he doesn't do it himself now, but he's able to oversee that. And he sometimes, makes surprise visits to properties. And he's on his guys and gals because he knows his stuff. And he tells me the story all the time where he'll be selling his properties to whoever, they'll be exiting a property, and the business plan for whoever's buying it, he'll get a hold of the business plan, and the first thing they're saying is like, oh, this is terrible management. We're going to be able to do much better on the management. We're going to reduce management costs by XYZ. That's an assumption, right? And so I'm like, okay, Ken's managing these properties as good as anybody, but the pitch or the assumption that the GP to justify the numbers is that we're going to do better than Ken. We're going to be able to reduce expenses instead of being at 40%, we're going to get to 35% or whatever. We're going to fire this person or pay less over here. And it's just kind of funny because obviously, he's not selling because he's stressed or he needs to, but he wants to sell. And it's interesting to see how the buyers spin the property that he's already kind of sold on.
I feel like that's a common play. It's like, oh, it's not well managed.
Yeah, right. That's
And other concerns that I think come into mind, I've been looking at deals recently where people are buying deals at 95% occupancy. Right. And, and they're like, oh, we're going to raise it to 98. And I'm like, well, you're already kind of at market, like where how are you going to go higher? I think if anything, there's a lot more risk of it going lower.
Right. But that's where, and I'm going to get, now it's fun for me now because I'm kind of, I sold my firm last year, so I don't really have a dog in the fight anymore. And I'm here just to mentor and teach. And it's fun because then I can, I can go both sides and I don't have to worry about anything. But I do blame the LPs a lot too. A lot of LPs are suffering. A lot of LPs are complaining. But a lot of LPs don't know how to do due diligence or didn't really do any due diligence. And so that's a great example. It's like, hey, if the sponsor is telling you that, well, this seems weird, but if it's at 95 now and the assumption is to go to 98, there's a bunch of things that you can do to go corroborate or see how likely that is. Like you could just sit at home and look at all the surrounding properties and see what they're leasing for. Like you can see what the rents are, what the occupancies are. You can pick up the phone and call property managers and ask them, hey, what's the occupancy in this building or in this marketplace? I'm looking to maybe buy, whatever. So there's things you can do, but of course they don't do any of that. They just rely on the sponsor, which is fine because to me, that's one of the most important things LPs should be doing is vetting the sponsor and their background and their experience and their all that stuff. So that's for sure. But you can also do some due diligence on the property that they're acquiring and all the other representations they're made, all the prior deals they've done. You can call up investors from prior deals. You can look at the properties. You can see if it's true. I mean, you can trust but verify, and a lot of LPs don't do that. So anyway, that's one of my pet peeves on the LP side. Yeah. I think there's blame going across because LPs are pissed. Let's make no mistake about it. LPs are pissed, and they should be pissed because a lot of sponsors are not communicating with them. They're not telling them what's going on. They're sticking their hands in their heads in the sand, and sponsors should be doubling, tripling, quadrupling their communications with investors when things aren't going well. And instead, they're going the opposite direction. And so I get it. They should be pissed. And for those that are not communicating. But also, I think LPs have some blame here as well for just assuming, hey, it's an ATM machine. I just throw money at this thing. I'm going to get rich. And that's not how it works.
Well, yeah, I think we were in an upcycle, right? And something that I teach in my Cash Flow Academy program is when you're an LP, due diligence is a spectrum. And there are people who are on the left side of the spectrum who say, my friend's investing in it and I trust him, and so I'm going to invest in the deal.
Yep.
And then there's the institutional firm with 20 analysts that spends the year, researching the heck out of this operator, and the reports that they pull are crazy, right? And you as an LP investor don't have those same resources or time or whatever, and so you need to figure out where in the spectrum do you sit.
Love it.
And then just know being aware of the trade-offs you're making by not calling the property management. See, like, I haven't called the property management company of a multifamily building I participated in, right? Like that's maybe. I mean, it's an interesting idea. I'm gonna put it in my bank now, but I think that it's figuring
100%.
out.
Yeah. So interesting thing. So just to add to your story, if you want to do digging to continue with your story, on the institutional side, there are individuals and institutions called registered investment advisors that actually invest and they counsel their clients and they basically manage their money, right? So they place money into syndications. Those firms will hire an attorney, not a syndication firm, but like a due diligence firm, to do two different types of due diligence. One is a due diligence on the sponsor, right? They'll do the due diligence. And these are like $25,000 checks that they write to do the due diligence on the actual sponsor, their track record, all that stuff. And then a separate $25,000 check to do due diligence on the fund itself or the project itself. So they're spending like $50,000. Now, granted, they're managing a lot of money, but that's on your spectrum all the way to the right side. I do the same thing for my syndicators. I have my elite syndicator program, and I say the same thing. It's like a lot of things on the legal side, on the compliance side, they're murky, they're gray, we're not quite sure. It's like, and it's like, okay, well, some syndicators, some operators are on the conservative side where they, some people just like investors. Like I'm putting my money in the bank. I'm putting my money in money markets account. Like that's it. And then on the other side of the spectrum, there's people who want to go to Vegas and put it on black, right? And you're going to be somewhere in the middle or somewhere in between. And depending on where you are will dictate how comfortable you are doing things. Like there are things that some clients that I had, there's no way they would do this because it's just way too close to being gray, or they think it's. And other ones, they were aggressive, like, no, let's do it. Like, I know I'm pushing the envelope and maybe it's a 50-50, but let's do it. And so I love your analogy of the spectrum because it's so true in a lot of aspects of life.
I would love to go back to, so much is good coming out of this. I'd love to go back to the loan portion because I think there's still some gold to uncover there. What can I, or anyone in our audience do to understand the loan products or the loan environment better, short of maybe having a mortgage broker here on the show?
I mean, look, on my most popular video, which is surprising, on my YouTube channel is an interview I did with James Eng, who's the national director of Old Capital, who's one of the top, lenders or really brokers out there. And so most of the information I got was from him. I've actually interviewed a bunch of lenders. There's so much information out there on YouTube, on podcasts so what I would do is I would just follow those guys. So anybody who's a lender or broker that's putting out content, they're going to give you up to speed on the current environment of where we are. So that's one thing to do. And then the other thing you can do is absolutely, now they may not give it to you, but there's no reason why an LP shouldn't, if they want to, ask for additional documentation from the sponsor, right? So there's nothing wrong with you saying, hey, it says here that your loan is a 3-year, can I see the loan documents? There's nothing that prevents you. Now, they're theoretically in no obligation to give it to you, but that might be a red flag. Or again, where do you fit on the spectrum? You may not be comfortable. Like, hey, if they're not going to give me this information, I'm going to pass because that's really important to me. I want to know what the loan product, I want to trust but verify. So I understand what you're telling me, but I'd like to have maybe my attorney even. LPs do have attorneys that review stuff. They review the PPMs, and maybe you have your attorney review the loan documents to see, hey, what's the risk of this loan product? They're saying so I'll give you a great example. Actually, these bridge loans were pitched most of the time as 3 + 1 + 1. So they're almost like a 5-year loan, but really they were 3-year loans with 2 1-year extensions. And even sponsors just assumed they were 5-year loans. So even sponsors didn't even realize this. And no, they were 3-year loans and there was an option for extensions, but there were some strings attached to those extensions. And a lot of the things that have been happening over the last couple of years haven't been there for those extensions to happen. So sponsors did think that they had a 5-year bridge loan when it really was only a 3-year. So things like that, I wouldn't necessarily know how to do that. But as an attorney, I am a big believer of spending a little bit of money to go have an attorney review the documents for you and then explain to you, okay, this is what this is how I would do it. This is what the sponsor's telling me. The loan is this. Is that what the loan documents actually say? And they're going to say no or yes, and here's some other risk that I see. So again, I'm a big believer in that. I know a lot of people don't want to spend a few, $1,000 or whatever to have, but I believe that on insurance policies, for example. I love having an insurance attorney review an insurance policy to tell me where all the holes are, what are all the exclusions, because that's I know we're going to get off on a tangent here, but that's one of my pet peeves as well with insurance companies, that people think they're making their premiums, but it turns out when it's time to collect, there's an exclusion buried on page 135. Well, an insurance attorney would be able to tell you, here are your holes. Do you want to fill them? Then you can make an intelligent decision. Same thing with these documents. You can request the documents, and you can go on. I mean, information is everywhere these days. So I would say it's no excuse. If you want to be informed, there's no reason you can't be. You don't have to have a connection at the bank or a connection at the lender and have to have coffee with them or pay them. It's all over YouTube and podcasts. There's no excuse.
Yeah, or maybe, I understand why an individual LP might be hesitant to spend the money because it just eats into returns.
Sure.
Especially if you don't end up doing the deal
Sure,
as well.
100%.
But I imagine that's maybe a role for it's not a third party separate, but I imagine maybe that's a role where it's syndicators or fund of funds. If you invest through that vehicle, they do, or you probably still have the same risk.
Well, you're going off to now the fund of funds. But theoretically, in a fund of funds, you're investing in a fund, and then that fund manager should be the one doing the due diligence on the underlying fund and requesting all this information. But now you're relying on your fund manager, who then to do the due diligence on the underlying. So that's actually what you're really paying them for, is to help you do that due diligence, and maybe because it's a larger fund, they can justify spending an attorney. Yeah. Because, on the PPM side, I don't do them anymore, but I used to when I was starting out. But there are a lot of syndication attorneys that will review a PPM, not usually that expensive. Maybe it's $1,000 or less, maybe. Well, they'll spend time reviewing the entire PPM, talking to you. The way I used to do it, I would meet with the client. I would say, hey, what is your understanding of the deal? Great. Then I would review the documents. Great. Then I would get on a call again and say, okay, well, you told me the deal was this. It's actually not that. There's a little tweak here. And then also here are 4 or 5 kind of red flags that I want to point out to you. I'm not there to make a decision for you. I just want to make sure you're aware of these. And then you can, again, figure out if the risk-adjusted return makes sense for you to proceed. But here are some issues that I see. And I've also interviewed a ton of LPs, and every, especially the sort of the more professional LPs, like literally who make a living being an LP. They look at things in the deal that most LPs didn't look at before, and now they're starting to little things like, for example, I was talking about, you probably know Jeremy Rauld, who's become a good friend too. I think he's in like a 60, I don't know how many, but he really looks at like indemnification language, for example, which I never thought anybody looked at indemnification language. He pays a lot of attention to preferred returns and how that's worded. So again, he's a professional, right? And I would encourage more and more LPs to treat it more as a sort of a professional side gig, right? Because obviously you're doing your thing, you're a W-2, you don't have the time, but it's not just a question of just writing a check. You've got to be able to do due diligence, and the more you can learn, and again, there's no excuses. You can listen to Jeremy's all over. Everybody's all over the place. There's no reason not to learn how to underwrite, how to review, how to do due diligence. You can learn that if you want to, and if you're going to be investing $100,000, $200,000, $300,000, I think it's well worth it.
So one of the big things, I think, as an LP, you're an attorney. So I'd love to dive into the topic of PPMs.
Yeah.
PPMs are a common thing that keep coming up of, hey, there's this big document. Most of it is boilerplate, I imagine, or in my experience, it's boilerplate. And then there's specific sections where it makes sense to pay attention. You noted on one, preferred return, haven't really focused on indemnification. I think money flow is important. What happens when the deal goes sideways? How many people need to be, like what kind of vote, what percentage of a vote needs to be there for, you to be able to kick out a GP, or what does that process look like?
Cash calls is a big one. Nobody paid attention to cash calls until recently. Right now, everybody's looking at cash call provisions, and yeah.
So what I'd love to maybe get from you here is someone's going to listen to this episode, and I want them to walk away with a checklist of, maybe they're looking at a deal right now, and here are the 5 areas, sections, whatever, I need to make sure I look at, and let's maybe attach a story to 1 or 2 of the things gone sideways.
I mean, it is technically part of the PPM, but I mean, the first thing I would look at, and I do look at, because I also do some LP investing, is I look at the sponsors themselves. Like there's a section, whether it's in the PPM itself or it's in the business plan that's attached to the PPM that's part of it, is what is the level of experience of this particular sponsor team, right? What's their track record? How have they done, especially in the last couple of years? Have they gone through some of these foreclosures or whatever? So that should be disclosed. And then more importantly, or just as important, is what is their level of experience in this particular asset class? Because they may be multifamily team, and then this is a self-storage, their first venture into self-storage. So who on the team is the self-storage? Because I don't expect, again, there's nothing wrong with if you're a multifamily and you like self-storage, you want to pivot, great. But who on your team has the self-storage? Who did you bring on to be the self-storage expert or the mobile home park expert? So that's another one. Or the experience or level of experience in the marketplace. Like, yeah, I might be, hey, I'm a Florida person, and then suddenly I'm going off to invest in Ohio. Cool. What's your team looking like in Ohio? Who do you know? So those are the kinds of things I like to look at even before I look at a deal. Like, to me, the sponsors at the top. Honestly, even before that, it's like my personal investment philosophy, like, you know, what the markets I'm looking at. But then the team starts to come in pretty quickly. Like, it's much more important for me to look at the team than it is the actual deal. And then even the market, like if I haven't done due diligence on the market, because I would start that way, right? I would be like, what are the markets that I like? And now I'm going to go find deals that are in my market, right? So if I've been researching and I say, look, I really like Miami, Florida, and I like Columbus, Ohio, and you have a deal in, you know, Colorado, then I'm just going to pass. Like, I'm not even going to get there, right? So again, it starts with your personal investment philosophy. It starts with what market, what research have you done?
We're going to put a pin in that one, and we're going to come back to that.
Let's go back. So I would start with that. So that's number one. I think you also, you hit it on the head. I mean, I think the what I call the waterfall distributions are critical. Like, what does the cash flow look like? You know, who gets paid first? You know, what are the fees? Are they coming out before or after? I think we did an amazing job of just making it super clear, like literally step 1, step 2, step 3 of how the cash flow was going. You know, first, you know, the first 100% of the distributions would go to the investors until they hit a 7% preferred. And then whatever was left over, 80% would go here, 20% would go here, like whatever. Just so the waterfall is super important for sure. The pref. When it comes to the preferred return, I would also pay very close attention to the language of the preferred return, because when you say preferred return, you probably have a different definition than I have a definition, than Bob has a definition.
And if it's cumulative or not.
So even just saying a pref, everybody has an idea of what that means, but you got to look at the document to see exactly what that means. There's I'll give you a quick story, and not a story, but like, there's a pref language out there that a particular group, one of these coaching programs does, and there's nothing wrong with it, but it's completely different from a traditional, what you think of a pref. They would do something where, let's say it was an 8% pref, and let's say it's 80-20. They would actually first split everything 80-20, right? And if the LPs were below the 8%, then the GP would start throwing money over the fence until they got to the 8%, which is a completely different calculation than if you did a traditional 8%. So if you mapped it out, which I've done for my program on a spreadsheet, the numbers come out very different depending on how you define a preferred return. And to your point, is it cumulative? Like, what if I'm short? Does it accumulate the following year? Does it accumulate at the end? Like, all those things. So preferred return, again, what we did in our PPMs is we did it in the definition. So you see a definition of a preferred return, it was like half a page long, right? And sometimes even examples of what it would look like. That way, when I'm drafting the language, I was always trying to write it in plain English, right? So then instead of trying to interrupt a sentence with all this other stuff, I would just say the investors will get the preferred return, period. And then you can go back to the definition of a preferred return, which is like, 100 pages long. So preferred return is another big one. Voting rights is very, very important. You should just assume you have no voting rights. I would start with that assumption. That's not my only one, but a little trick of the trade. We would get a little sneaky, for lack of a better word, in the way we worded the voting language, because, well, even before I get to that, when you think about the voting language, many sponsors, and I actually recommend this too, is if sponsors put cash in the deal, which they should, I like the cash to go in the same class as the investors, because I'm putting in my cash. So if the investors are going to get a 7% pref, I want my cash to get a 7% pref, and I want my priority, just like I want to be treated like any other LP, in addition to my role as a GP and my carried interest. Well, now I've got putting myself in Class A, I'm also getting some voting rights over there, right? So obviously I'm not going to be voting against myself to vote out. So I've kind of stacked the deck a little bit on the voting rights. Whatever little voting rights they already had, I'm part of that voting group already, number one. And then number two is, like, well, how is it worded? Is it, for example, I wouldn't do it, mine would all super majorities, but even if it was a super majority, I think one of them, a lot of times I would have like a 75%, like, here's a good example. You need 75% voting rights to do something. Like, say you want to fire the manager. So, well, you need 75% vote. Cool. Well, is it 75% of the entire company? Or is it 75% of the Class A? Because if it's 75% of the entire company and Class A only has 80%, it's 75% of 80, that's like a 92% voting. And then if on top of that, you've got GPs that are also LP, it's almost like illusory. So I would just assume as an LP, I have no voting rights, which is why it's so critical to do all of your due diligence, all of your work up front, because the minute you write that check and sign those documents, you have zero control.
And it's just a reality of LP investing.
Yeah.
Not that it's like, you don't have any voting rights, so you should skip the deal. It's like...
That's a good point, yes. To be fair, that's how it usually works. In fact, if you have a traditional, we don't really do GPs and LPs. We don't use general partners anymore. We use LLCs. So we actually have managers and members. But the reality is, in an LP GP stamp, all of the voting rights are with the GP and the LPs have zero. Now, I don't like to have zero because, in my mind, a lot of them have zero. I was like, well, what if the manager's stealing money and they're commingling and they're buying yachts? I mean, there's got to be at least something where if they're doing something that egregious, there has to be something in the documents that give, even if it's 100% vote from the investors. So I did carve out, but some people carve out zero stuff. But it's important because, so you should assume that's common, no voting rights. But you also don't want any voting rights from a protection standpoint. I'm a retired asset protection attorney. I actually wrote a book, kind of an asset protection book for Ken McElroy. You don't want to have say in the deal because you would lose your protection. So right now you invest $100,000 or $50,000 into a deal. Because it's a limited liability company, you're a member, a limited member, or a limited partner, your risk is limited to the amount of money you put in the deal, right? If I put in 50 grand and the whole thing blows up and people die or the loan gets, like, that's it. They can't come after me for more. But if I'm now involved in the decision-making process, there's a chance that I may lose that protection. So if it comes out that, like, hey, I came in and I wanted to become part of the decision-making committee, or we set up some kind of a board and I was involved, and something happened, and I can tie the result to that decision, well, now I have unlimited exposure, right? So my limited of 100,000 becomes they can come after everything. So as a limited partner, you want to be very, very careful of going in there and trying to control things, because if that control leads to losses, there's a chance that limited liability piece can be pierced.
Are there clear red flags where you see this in a document? You turn away, or I think it's what I'm trying to do is provide guidance more than someone just looking at the PPM, reading over a couple clauses and saying, okay, this is good. Because I've been guilty of that. I think now you have ChatGPT, which is a little bit better, that you could maybe ask it, what are scenarios I need to think through. But
that, by the way, that's a great little side note. If you're not using ChatGPT, you should absolutely, and granted it's but it's already a public, you can upload the PPM to ChatGPT and then start talking to it. Hey, what are the preferred returns? How are they calculated? What if this happens? What if that happens? Is there something in the document that says this, that? You can literally start a conversation based on the actual document. So that's something I would, in any document, a loan document, or an insurance policy, upload the insurance policy, start asking, hey, does it cover this? Does it cover that? What if this? What if that? So anyways, that's a great...
Well, maybe we can, if there are enough comments, maybe we can get Mauricio to give us a checklist that we can put into ChatGPT.
Like a prompt. Look, honestly, I think people overvalue the PPM. I mean, the main thing of a PPM is just to make sure all the risks are there. So it's really, that's what it's there for. It's not necessarily a red flag. You won't know. I mean, if there's a risk that's missing, you're not going to know. That's just going to be a remedy for you later on. Like if something happens and that wasn't disclosed, or you find out the manager's getting paid something and that wasn't disclosed, or they end up doing something that you're like, wait a minute, that wasn't discussed and it's not in the PPM. That's really what the PPM is for. I think the biggest red flag for me would be if there is no PPM. That happens a lot. So if I'm in a deal or somebody's pitching me something and I'm like, well, can I see the PPM? And they're like, oh, we don't need one, or we don't have to do one. And you talk to some people and like they have to, which happens a lot, by the way. So anytime you have any non-accredited investors in your deal, you have to provide a PPM. Then that's a red flag for sure. Like that means they're not working with an attorney, they're cutting corners, they're trying to save money here, where else are they going to serve? And I've had a few of those for sure. And the excuses I hear as to why no PPM is required. But honestly, it's more about the disclosure is that document. The PPM is, let me give a quick story on the PPM. I always equate it to the medical consent form. Like if you go into I have horrendous teeth. I just don't take care of my teeth. I've had oral surgery 1,000 times. And every time I go, like say even if they go take a tooth out or whatever, I'll go into the dentist, right, the oral surgeon, and they send you that little yellow sheet, right? Like, oh, we're going to have your thing. We're going to put you under. You could have some bleeding. You could have an infection. You could die from me like all of those things. And you read the risks and you sign off and the doctor signs off, boom, and they do the procedure. That's what a PPM is. It's just a risk disclosure, all the ways things can go wrong. And then it's kind of your document, like if something does go wrong in the future, you can then go back and point to and say, hey, this was never disclosed, or you said it was going to be this way and you did that way. Had you done it that way, I wouldn't have invested based on that disclosure.
Very helpful.
Yeah.
Very helpful. You touched a little bit on document. Actually, I would love to go back to the point of personal investment thesis. This is something that that is probably the overarching part of the program that I run, which is, so everyone asks, how do I know if this is a good deal? And to me, the first question is, doesn't have to do with the deal. I don't think even has to do with the sponsor. I think it has to do with what is your investment philosophy. Okay, I'm investing for cash flow. That's what I want out of this $50,000. Okay, what are the best asset classes that I can invest into that provide that cash flow? Maybe it's private credit. Maybe it's oil and gas. Maybe it's a well-structured multifamily deal specifically for cash flow. And all of those things change if you're looking for equity growth. Do I want monthly or do I want quarterly distributions? What kind of access do I need to the capital? And I think all of that, you then have a deal come through your inbox and you say, oh, does this have quarterly cash flow? No? Okay. Not a good deal for me, And so I would love to understand, maybe for you to riff on that, or if you have a different take, how you think of your investment philosophy, what goes into that before even looking at it.
Yeah, some people call it a buy box, but I want to give credit where credit's due. I got this from my buddy Robert Helms, the real estate guys. He always talks about you start at the top with your personal investment philosophy. That's the first thing at the top you figure out. Then below that, I believe he talked about what's the market that I talked about. What's the market or markets that I'm interested because I've done my research and I believe those are great markets. Because you can have a crappy deal and it just happens to be in a great market. It's going to bail you out and vice versa. Then the next level is the team. Like, hey, let's say we're in Miami. Like, what kind of team do they have? A good property manager in Miami? Do they have like whatever? And then the deal is at the bottom. Like the deal is the one that's most interchangeable in this entire thing. So it starts out with that personal investment philosophy. And it could even start with things like, do I want to be an LP or do I want to actively invest? Do I want to invest within a certain radius of where I live because I want to be able to go walk to my properties, or am I comfortable investing in the entire United States, or am I comfortable investing in the entire world? Right? Some people, we have investments in Mexico and Belize and like, right. Do you invest for cash flow or are you investing for appreciation? So all of that stuff is, and then the buy box specifically, like I do, like Jeremy Roll always talks about, like he needs a preferred return. If there's no pref, he's out. I hope that's right. But like, that's a personal investment philosophy. You may not agree with it. Like, I don't need that or so some things. So that's at the top. That's always the first thing you want to look at, because then answering the question, is this a good deal or not? It's the better question, I guess, is this a good deal for me?
Exactly.
Right. And that's the more important question. And so where are you in life? Are you looking for capital appreciation? Am I early on in my career where I just want to triple my money? Or am I now in my 60s where I'm just looking for preservation of capital? So maybe a preferred equity kind of structure is great because I got preferential. For those of you who don't know, preferred equity means that my money's coming in and I'm going to get paid first before any of the other equity. And I'm still behind the main loan. But again, it's a little bit more protection. And in exchange for that, I'm getting paid less because my risk-adjusted return is lower. So I have less risk, but as a result, I have less return. If the deal goes great, I'm not going to participate with the huge upside. But so again, I don't know where you are in life. Like, you and I are in different stages in our lives, right? So I'm going to be looking for different things. So it always starts with that before you even look at that. And then, like I said, the next thing you want to look at, we could interchangeably the market, or in our world, the sponsor. I mean, to me, it's all about the sponsor. I mean, it's like 80 or 90% of it to me is who's the sponsor, what's the track record, can they pull off this pretty pitch deck that they put together, what makes me think they can do it. And I will spend all of my time on that. And the nice thing about that is you just do that once, right? So if you find somebody you really like, and then you start looking at the deals, Ken's a good example. Like once you know Ken, it's personal, Ken, you like what he does. And then I don't have to do due diligence on Ken every single time. I just have to look at the specific deal but the deal might be in freaking some, whatever, or he might be changing asset classes. He might like, hey, like Grant Cardone's a great example. Like, whether you like Grant or not, I don't know. And I don't know him personally, but he's a multifamily guy. And then the last thing I saw him do, he had a little bit of a curveball. He's now integrating Bitcoin into his fund. All right, well, that's a completely different risk profile. And so, again, do I like Bitcoin? So what does he know about Bitcoin? Like, I don't know if what does he know about Bitcoin? Does he have somebody in his team that's a Bitcoin? Like, that's a completely different ballgame. So I always focus more on the team in that sense. And originally in this pyramid or stack, when we say team, it's really more about team. Who's the team on the ground? Like, who's the lawyer? Who's the broker? Who's the property manager? Who's your boots on the ground? Like that kind of thing. But in the syndication, you also want to know who are the sponsors, right? That to me is so critical. But again, back to the frame, it's all about personal, and maybe that is also a personal investment philosophy. My personal investment philosophy is I look at the sponsor, and I care way more about the sponsor than I do about the nuts and bolts of the deal. So that's a philosophy.
Are you comfortable sharing maybe a little bit higher level, so people can think for themselves what theirs might be like? Oh, I typically invest for equity. I like seeing pref. I like these markets. I don't like these. Yeah.
I think the big one is the markets. I think as an LP, assuming you're in real estate.
See, I don't focus on markets personally.
Okay, good. So that's great. So I mean, so if as an LP or as a real estate, I don't do my own. I'm not an operator, right? I'd like to do that, but when I get to that point where I'm going to do my own stuff on operations, and certainly when as an MLLP, there's got to be a story behind the market that I want to be in. Because like I said, a good market raises, what's the saying, like a tide raises all boats or whatever, right? So if I'm in a hot market that just doesn't have any drivers behind it, there's no job growth, there's no demographics moving, there's just like whatever, then I'd rather invest in this market. Like I've done my research and I've come up with these two markets that I like. And so it's an easy way to filter out deals, because is your deal in one of these markets? No, then I'm going to pass. And like, bring me a deal that's I love Miami. I'm making this up, but I love Miami. Maybe I need to go talk to Grant Cardone. I think all his deals a lot of them are in Miami. I love Miami. I think my buddy Rich Summers, he's actually in California. He does boutique hotels. That's his asset class, right? I don't know anything about boutique hotels. It's a very interesting model. But if I look at the boutique hotel business, I'm like, wow, this is an interesting model because okay, well, I'm only going to look at deals that are boutique hotel deals. I mean, if you give me a multifamily deal or a self-storage, no. I like boutique hotels. That's the asset class this is one of the two asset classes I'm looking at. So it helps you filter right off the top. But having a very clear, and this goes with life in general, if having a clear vision, a clear personal investment philosophy, once that's clear, everything else just becomes super obvious.
Yeah. Thanks for sharing. I resonate with that. Going to GPs a little bit, I'm constantly thinking, okay, what are the I'm going to test some filters that I have against you to see if they are reasonable or unreasonable.
Okay.
So one of the things that you touched on a little bit earlier, nothing necessarily wrong with a GP transitioning to another asset class. To me, always the first question is, how many deals have you done, preferably full cycle, in that asset class or in that specific strategy that I am investing in? I don't personally like investing with multi-asset class operators.
Okay.
Because my thesis is I would rather invest in the person that's done the same thing for a decade in the same asset class versus multiple. What's your take?
Well, let me push back on that a little bit. I've got a client whose thesis, which resonates a ton, is he's in it for the tax advantages of the investment. So that's his thread. He doesn't care if it's multifamily, if it's oil and gas, if it's Bitcoin, if there's a tax advantage, a conservation easement, like that's what his group of investors are looking for are the tax benefits, because his investors are high W-2, high income earners, doctors, lawyers, whatever, that just have a ton of cash but don't have any. So he's less concerned about the specific asset class. He's like, does it have the maximum type of depreciation, bonus depreciation? So is it car washes? Is it mobile home parks? Is it what can he depreciate the most? Is it short-term rental? Like whatever it is, if it's got a great tax play, then that's his thing, right? So that's an example of where it would go. And then I do think there's value in somebody who is in a particular asset class. For example, let's say you're in multifamily and you're like, hey, I think we're a little frothy on the multifamily. I think we're going to have a couple of years of really tough things, and this other asset class is in a different cycle and it's coming out of a bottom, and I think there's opportunity there. I don't have a problem with them switching over. I do, going back to the original point, I want to see somebody on their team though that does have the track record in that new asset. If they've never done it, this is their first rodeo. I don't like investing in first rodeos. So if this is the first rodeo in self-storage, I'm out. But if they've brought either joint venture with someone that's usually how it works with the really good ones, is that they'll transition to another asset class, but they'll partner with one of the top experts in that particular asset class. So they'll partner together. So, okay, cool. So now I'm comfortable because they partner with somebody who has a 20-year track record in self-storage. So I'm comfortable there. If it's the first time, like they've never talked about self-storage and like, oh, we just seem to find it, that I would be hesitant in. But if they partner or bring somebody else on the team that is an expert, then I would grill that particular, I would look very closely on that person. Like, well, how many years, how many cycles, the same thing, the same due diligence I would have done on the team. I'm going to do the due diligence on that particular.
But still risk, because it's a new team to a new product.
Correct. You have to start the due diligence from scratch. Like, who is this person? What's their background? Let's trust but verify, whatever they're.
I mean, for me, even just the risk of the whole team not having done the deal together before.
Sure.
Would be
don't get me started on that. Don't get me started on that one.
Okay. Second one would be in-house. So let's say I'm going to call it a ragtag team. So a team that has come together. Maybe they've done a couple deals. They're doing deals on their own. Like some of the players are doing deals on their own, and they're coming together to do a deal together. Not my ideal.
I agree. I don't like that at all. And by the way, on the compliance side, it's really important too, because and even when I look back, I mean, one of the things I forget I'm blessed because I work with. I mean, we used to do Premier Law Group, still does that. Like, hundreds of these every year. So I mean, I know a lot of sponsor teams, and I've seen all of them, right? But the ones that tend to excel the most are the ones that have a dedicated team. I started my company and I've got people, I'm not pulling people from different, it's like they're part of my company, my team. Yeah, once in a while they'll partner with another group or whatever, but it's not 3 or 4 from every deal's from 3 or 4. Because the reality is the reason they're doing that is most likely is that they are really there for the capital raising, which is problematic. And that's why I have an issue with it. But again, going back to my, Ken McElroy, who a lot of people think of him as, maybe the GOAT is a little too much, but like he's one of the top syndicators. He's got his company. It's MC Companies. He's got 230 employees. He's got him as his partner, and his, maybe his chief investment officer will circuit, whatever. But it's a core group, right? He doesn't have like, well, this deal I'm partnering with Bob. The next one it's Pascal, Mauricio. No, it's like here's his group. And a lot of the top, as I'm thinking through all my top syndicator clients, they have their own. And a lot of them are fully vertically integrated. I mean, they're real businesses, right?
You touched on the third point that I wanted to make, which I'm not good at explaining the other side, and my opinion's becoming less strong on this, I think. But in-house property management versus outsourced, because if the driving factor of the property's value is the net income from the property, and that's managed by someone else who has different incentive structure, percentage of revenue versus value of the building as an operator, that doesn't, and I've invested in a couple of those deals. I think that's a little, I'm now kind of more inclined to just work with vertically integrated. company's thoughts.
Yeah, again, I'm not an operator, so I'm not qualified to make. I've actually had a couple of people on my podcast where I've had that discussion. Hey, talk about the pros and cons of going in-house versus off. I've actually wanted to do, and I'll probably do it here soon. I love doing debates on stuff, so I want to do a debate of that exact topic. So, I'll find people who are really adamant about, hey, we're fully integrated and this is why we strongly believe in this. And sometimes, by the way, it's just economics. It's just economies of scale. It's just, or they just can't find people that are good enough in their minds, and so they do it themselves. I mean, Ken's obviously vertically integrated, but other people have really good arguments as to why a third property is just as good or whatever. And so, yeah, but I'm not in a position to give. That's way outside my wheelhouse.
Yeah. Do you have a preference on deals that you invest in?
That's not one of the things I focus on.
Okay.
Yeah, that's not something that's on my list.
Okay, great. I just wanted to get a good litmus test there. So, I think I would love to just kind of, as we wrap a little bit, get a little bit of your take on the landscape of syndications. Where do you think, over the next several years, an LP should look out for in terms of, man, there are a lot more new GPs coming onto the market, or there's, I'm seeing this trend where people are skipping over putting together a PPM, or I don't know.
Yeah, I mean, the one comment you made, that ship has sailed. A couple of years ago, I was out there, and in full disclosure, I saw it somewhere. I don't know what the source of this was, but everybody was saying it. And maybe it all started with me, but 70% of syndicators had 3 years or less of experience. So that was a stat that was going out there, and anyway, the number might not be exact, but the sentiment was there. Like everybody, the Uber driver, everybody was a syndicator in 2021 because it was like throwing a darts at you just buy something and the market would bail you out. Actually, one of my good friends, Ashley, Ashley Wilson, she talked about this a lot, where a lot of syndicators in 2018, 2019, 2020, they look like they were crushing it because they were returning ridiculous returns, right? But if you looked under the hood,
NOI growth.
Yes, if you looked under the hood, the reason that they crushed it is because of cap rate compression, right? It wasn't because they even hit their NOI growth numbers or their percentage. The rents didn't get where they wanted to get. They didn't get out. Basically, as an operational unit, they failed. But because rate caps compressed so much, meaning the property value went so high, they just cashed out and they looked like heroes. Well, that gravy's gone. So if you're looking over the next few years, there's a premium now on the operations, right? So there's one thing to raise the money. Now it's about operations. You're not going to get the returns out of a property. Hopefully you will, but you're not going to be able to rely on the price of the property being higher when you sell it just on its own from a market perspective or cap rate compression. It's going to have to be from actual operations of actually getting the net operating income up, which means getting the rents up, getting the NOI up, and forcing that equity in there so you can actually you can get the better price on the back end. But a lot of syndicators, so that's one thing I'd be wary about. Again, going back to what's the track record, and again, that's something that, again, Ashley talked about this all the time. So this is something you would be able to do. It's like when you're looking at when you're doing the due diligence on the sponsor and you're looking at their track record, either ask them or request the docs. Like, show me the pro forma that you had when you did the last raise, and then tell me what you sold it at, and then start looking. Did they pull off the business plan or not, or did they just sell at a rate cap compression? Because they're not going to be able to sell at a rate cap compression now. So that's a little bit more digging into the numbers. That's
it's more than just IRR.
That's another thing. That's another, yeah.
And this is something I've learned a couple of years in. It's focusing on the NOI growth. Like, I'm seeing some operators now show, here are the last 3 deals and the NOI growth that we had.
Perfect.
Even though the deal might not be a great IRR,
yes,
we as an operating team crushed the operational plan.
Yeah, and I think even just those two, because that's what you can control. That's what the operating controls. So going back to what I would look at is the NOI growth. So, hey, what was the NOI when you bought the property, and what was the NOI when you sold it, or what is it today? And then what's the occupancy? What's the occupancy when you bought it, and what is so those two metrics show you, I think, how good the operations were of a particular price, especially if it's a value add, which most of them are. The cap rate you have no control over. Like, interest rate, I mean, you have no control of what the selling price is going to be in terms of the cap rate. What you do have control over is NOI and occupancy. And so I think that's something I would focus on. So I love that. If somebody's like, hey, you're my last three. And actually, if you're a really good operator, and maybe your numbers aren't spectacular because of the market, whatever. Hey, I bought it. If you bought something in 2022, I mean, and you're trying to sell it today, But even if you could even show like theoretically a loss on the investment, but say, hey, but I grew NOI by X%. I did my job. But unfortunately, the cap rates just, oh my God, they just spiked too much, and because every time the cap rate goes up, I think it's every point that the cap rate goes up, it just wipes out like 20% of your NOI. So it's like you have no control over that, but you do have control over NOI and occupancy, and so that's a great disclosure or a request that you could make for sure. The other thing, by the way, you talked about it, which is another probably a whole new episode, but I do think what's going to start, especially with what's going on with the crypto world. A couple of years ago, I was out there saying that I believed that the vast majority of syndications in the near future, I think back then I was saying 5 years, were going to be tokenized, right, on blockchain or whatever. And I do believe that's coming, whether it's 5 years. I mean, we obviously went through a little bit of a crypto winter. And this is not cryptocurrency. This is tokens, right? So this is taking the LLC membership certificates, right, turning them into or having a digital representation of those and putting those on blockchain. I think that's coming for sure. Like in the next 10, especially with the sentiment now and the regulations are coming down, it's already out there. I was getting a ton of calls. I said 10 calls, maybe 1 or 2 calls a month about people wanting to tokenize. We did a few tokenizations back in 2022 with crypto the way it was the last few years. The winter, that's gone away. But there's a Ritz-Carlton that sold. I think they sold 19% of their thing through a tokenized, what's called a security token offering. I think that's coming. And it's going to open up a lot of things because you're going to be able to put all of the information on the property, the rent rolls, the occupancy, the NOI, the P&Ls, the tax, all of that's going to be on blockchain, and it's going to be verified. Right?
And a lot more transparent.
And there's going to be a lot more transparency, and it's going to allow people to really switch, trade their shares after there's a 1-year holding period. But hey, if I bought, $100,000, let's say I invested $100,000 in a particular deal, I own 2% of the deal, that gets turned into 20 tokens, right? And then a year from now, I can sell you 3 tokens. I can swap them out with other people, so I can, maybe diversify a little bit, or if I need liquidity. So all that's getting built out. Again, it already exists. It's just, for example, there's some marketplaces right now where it already exists, but there's 3 sponsors and 7 investors, right? That'll get to the point where there'll be thousands of investors in there, and it'll get to a point in the future where it'll be like a stock market, where there'll just be such a great marketplace where that you'll be able to freely trade your syndication. So I think that's going to be pretty exciting. But that's probably another 5 to 10 years out.
Yeah, primary benefit is liquidity and transparency.
Yes,
I guess.
I think the transparency. Yeah, transparency.
I'm seeing a ton of syndicator, fund-to-fund capital raisers out. And it seems to only be becoming more prominent, maybe because I'm just getting into the space a lot more. Do you have a take on the proliferation?
I could riff off this for an hour, and so I'll try and control myself. There's a lot of capital raisers, which really drives me crazy, to be honest with you. First of all, I don't like the term capital raiser in general. I use it now because it's vernacular, but if you're a capital raiser, meaning you're in the business of raising capital for other people, that's a licensed activity, right? You need either a broker-dealer license, which you don't have, or you need to be a registered representative under the broker. So you need to pass like I forget what series, but you got to pass some exams, you got to hang your license. Nobody does that, right? And so the way people were getting around that was several years ago, they were doing what was called the co-GP model, meaning they would come on as a co-sponsor on a deal and get compensated that way. The challenge was that you still can't get compensated even if you do that model, but there was things you could do to sort of get into an exemption. Everybody's trying to fit into an exemption, so you didn't have to get the license. The challenge was they were starting to have like 8, 9, 10, 12, 13, 15 sponsors on a particular deal, which A, makes no sense because you're diluting yourself, but B, it's because they were primarily being brought in to raise the capital, and that was getting out of hand. So what's happened lately is there's a shift to this other model called the fund-to-funds model, which is, hey, I'm really good at raising money. So instead of being a co-GP, which is kind of a little sketch because I'm not really doing any work, and I don't really want to do any work, I just want to raise money, go get a license is what I usually say. But okay, cool. Well, why don't I just create my own syndication, my own fund, and do that properly, get a securities attorney, do a PPM, raise the money, do the disclosures into my fund, and then with the money in there, I'll start giving it to Pascal, give it to, whatever, I'll start allocating. I'm Warren Buffett. I'm just going to start, So that's a great model. So that there is a model that if done properly, that is a fantastic model. The challenge is that it brings in a ton more regulations and compliance that people don't want to hear. And so it tends to be a little bit more expensive, a little bit more complicated. And my beef really it's just the marketing, right? A lot of marketers are there, they're pitching this as it's quicker, faster, easier, whatever. And it's not, it's more complicated, it's more expensive, whatever. So usually, not to get nerdy on the legal stuff, but as you know, like an LP should know this. So I don't want to, so LP should know this, but generally when syndicators sell you an investment, they're selling you a security, right? And so they either have to register that security or they have to find an exemption. And everybody usually relies on this thing called a 506B exemption, maybe a 506C. So LP should be aware of that when they're signing document, they should know if it's a 506B or a 506C offering. But when you're investing in real estate, right, which is what we do, a lot of us do, you don't need a license to invest in real estate, right? I don't need a license to go buy property. But when you start investing in other people's syndications, you are now investing in shares in their companies. You're an LP in their deals. You're now investing in securities, which changes the game now because now there's all these other statutes and laws and acts that I didn't have to worry about before, but now I have to worry about, like the Investment Companies Act is something that I don't usually worry about in real estate, but I have to worry about in fund of funds. The Investment Advisors Act, because I'm an investment advisor. The broker-dealer laws, I think, still come into play. And so my complaint right now is twofold. One is, and I've been very careful with my language here, a true fund of funds is someone that raises money into a fund and then goes and invests in multiple, they go and do their due diligence on multiple sponsors, multiple deals, and they invest in multiple deals. And that's really what they're getting compensated for. You don't have time to go meet with you. You don't even have access. I've got access to Pascal. I've met him. I've come to his office. I've done my due diligence. I've seen his operations. I've looked at the deal. I'm an expert. I know how to underwrite. It's a good deal. I'm going to place that money into that deal. Next deal, next deal. What a lot of people are doing, calling fund of funds, is really what I call a feeder fund. Which are, again, also legitimate. There are legitimate reasons to have a feeder fund, but a feeder fund is just feeding your money into one investor, right? Where you're specifically telling them, I'm going to put my money into Pascal's deal, and that's what I'm raising. I'm raising $1 million, and I'm going to give it to Pascal. That's an investment advisory activity, right? And most of the people who were in the private equity world that do, they actually have registered investment advisors as part of that team because they're an investment advisor. Now, we have some exemptions depending on what state we're on, but nobody wants to hear that because that just means more cost, more compliance. And if they just want to raise a couple $100,000, it doesn't make any sense. I don't want to do a PPM, like all this stuff. So I think that's a big red flag in the industry to me if it's not done properly. I was actually talking to a colleague of mine, great guy, Michael. He was on my podcast. He's one of these great fund attorneys who used to work for a huge law firm, big law firm, and now he has his own practice. And I asked him, hey, what's sort of the minimum, if you're going to do a fund of funds, how much, at what level does it make sense to do a fund of funds? He said $35 million.
Wow.
And I'm like, okay, well, I disagree with that, but because I think he's also in a different, but at least $1 million, it's got to be at least $1 million or $2 million to do a true, and again, the fund of funds, ideally, you're investing in multiple deals. But yeah, again, it's just smoke and mirrors. If you're raising money from your investors and primarily for just me to give it to you, it's all smoke and mirrors. I'm basically just, what am I doing? I'm raising money and I'm giving it to you. I'm acting as a broker. I'm brokering that transaction.
Right.
There's all these entities and smoke. So I have to be doing something to earn my fee that can't just be raising money for you. So I have to either be negotiating a better deal. That's a great one. Like, hey, I know you're offering 70-30. Hey, I'm bringing in $1 million or $500,000. I want 80-20. I know you're only giving a 7% pref. I want a 10% pref. I want a seat at the table. I want to be on your advisory board. Like all those things you negotiate at the benefit of your investors. Great. That's something I've earned my fee. I'm an expert in or maybe it's a self-storage deal. I'm an expert in self-storage. My investors have no clue about self-storage. So I'm going to vet you and do the underwriting and look at the stuff. And that's what I'm getting paid for. A lot of these feeder funds and capital raises, they don't know anything about anything. And to circle back, and then I'll shut up because I don't have time. My biggest pet peeve of all times is that the reason you raise money is because you are already doing something. You're either building a business, you're investing in real estate, you're a multifamily person, whatever, and you just need more capital, like to scale, to grow, but you have a skill set. and you need more money and you're willing to bring in investors into your thing, right? Think Facebook. Facebook has investors. They have a platform. They want to grow it. They get investors to keep investing. There's just way too many people who skip that part, and they're just raising money. They don't know anything about the asset class or how to underwrite, or they're not very good at it. Maybe they know a little bit, but they're certainly not experts. And they're just out there raising money. That's their skill set, is I'm a capital raiser. And if you're a capital raiser, then go get yourself a license.
So if you're an LP, is there a question you're asking yourself when you're, I don't know, let's say you're looking at a deal, you watch the webinar, it looks really interesting, and I don't know, you're sitting there asking like, okay, is the person who's showing me a deal, are they a fund-of-fund manager? If yes, are they, like, what's the question I'm asking myself?
So the question I would ask, because this is part of the due diligence on the sponsor, is whoever your whoever's talking to you and pitching you the deal, I would ask them, what is their involvement in the deal once the deal closes? Like when we close, okay, great, I'm going to invest. Are you going to be my point of contact? Are you my investor relations person? Are you my who do I call you? Are you the one that's actually going to be managing the asset? What's your role? Right? Because a lot of times their role disappears. Like they raise the money, they got you in, and then they're gone. You know, they don't do anything, right? I mean, they kind of have to try and figure out what to do, but they're really not doing it. So who's the one? Are they the manager of the manager? Are they the ones that are actually hands-on? So that's one question. And if it's a fund of funds, then it just has to be, I mean, it should be crystal clear. I mean, the presentation should be, hey, I am raising money for this fund, and here's one of the investments we're looking at, right? And this is Pascal. I've known him for a while. He's great, but we're going to be allocating $500,000 or $1 million to this deal. Let me show you about the deal. Although again, with a true fund of funds, the investor doesn't get to see that, right? It's like I'm investing in, it's like, let's say you're the Pascal, you're the fund manager. I'm investing in you. You're an expert. You know how to go identify deals. I'm going to give you $100,000, and then you're going to take that money and you're going to go find the deals. You're not really pitching me a specific deal with a fund of funds. With a feeder fund, yes, you are pitching me a deal, but it should be very clear from the presentation that you're investing into my fund, and I've already told you I'm going to be investing in Pascal's fund. So we're doing this webinar so Pascal can show us a little bit. Honestly, really, as the fund manager, I should be really the one that, in my opinion, being the one that's presenting the deal, because I should know the deal just as good as anybody else. I'm investing in it. So why do I need Pascal? You know, I should have all the answers already. I've already done the due diligence. I should know everything about this deal anyway. I shouldn't even need you on the call, is one of the ways I look at it too.
Yeah. Right now, I'd love to just kind of focus on, you've launched this new program.
Yeah.
Tell us about that. And
there's something called the syndicator blind spot, right? There's this gap that I've really wanted to address for a very long time, so I'm super pumped about this. There's so many people out there, syndicators, who want to go raise money and go do deals. And then at some point, they're going to hire an attorney to do the docs. That's another pet peeve, which we'll do another episode. But I just need the PPM, right? Then there's that gap between the time they want to raise the money and the time they hire an attorney. That they're out there, they're talking to people, they're going to meetups, they're going to conferences, they're posting on social media, they're setting up entities, they're doing the websites, and they have nobody helping them out, no lawyer to look at, nobody looking over the shoulder. There's just landmines everywhere. And so I've been wanting to fill that gap, that syndicator blind spot gap, for a long time. And so I launched this elite syndicator program specifically to address all those issues that happen before you actually hire your attorney. Because once you hire an attorney, assuming they're SEC specialized, I mean, they should be able to handle the stuff from that point on. But the amount of nonsense that goes on, I mean, I got calls all the time where they would say, hey, Mauricio, I've got a deal in the contract, we close in a couple of weeks, whatever. I've already got all the money raised. I just need the paperwork. And I'm like, what did you tell them about, like, what did you give them? Like, did you give them a underwriting, a pitch deck? They're communicating with the investors, and they have nobody overseeing their stuff. I just saw a post, you probably saw it too, a couple of days ago on LinkedIn, and it was like, it's a meetup or whatever, and they're talking about how you can get basically compensated to raise money, and there was like 15% for that. And I'm like, there's nobody helping them out. And so I wanted to create this program where we would meet once a week. I would do a little presentation on some topic that was relevant, but honestly, it was just an opportunity for me to implement I talk about all the rules, This is like an implementation call where, hey, let's look at your social media posts that you're thinking about doing. Oh, you're going to go to this event tomorrow and talk about that. What can you say? What can you not say? What exemption are you using? Let me look at your underwriting. Let me look at the email you want to send out. Let me look at your website. Is your website compliant? Let me look at so all of that stuff. I just want to have an access point so that if you had a question during that gap, that you had an outlet where you can come on the call, ask me a question, and that gap is just, I'm just calling it the syndicator blind spot because they have no idea that they're out there violating rules left and right.
Yeah, so Mauricio here making sure that people are in compliance and check.
Yeah.
You're actually the first attorney that I came to when I started this process. So that's so clearly focused on the operator side of the coin.
Yes.
For an LP that's listening to this call, are you someone that they can reach out to and pay some money and review a PPM, or is there a better attorney or someone else?
I've got a few that I could recommend. I don't do that anymore, but yeah, if somebody's interested, just find me on social. Maybe Instagram's probably a good one. Just follow me there, DM me. I do a lot of content that does indirectly help the LPs, especially when it comes to asset protection and estate planning. And so I wrote a book under Ken McElroy's company called Legal Strategies for Everyone. So it is for everyone. It's primarily an asset protection book. So it'll show you, how to set up LLCs, where to set up LLCs. Do I set them up in Wyoming, Nevada, like I say, or do I set them up here in Florida because here's where I'm operating? And then I have chapters on a chapter on raising capital, but estate planning and all the other kind of basic, how to work with lawyers, how to save money with lawyers, kind of an introductory book. But my primary role is I do represent GPs. That's my bread and butter.
Yeah. All right, well, if anyone wants to just, snoop, do some more research about you, look into what you do, what are the best platforms that people can reach you on? I'm
very, very active on LinkedIn. I'm pretty active all over the place, but LinkedIn's probably my favorite, and then YouTube. Those are probably the two. So if you're not following me on LinkedIn, you want to learn a little bit about sort of from the perspective of the GP. Although again, I do put a lot of content out on LP stuff. Follow me on LinkedIn, YouTube, or Instagram. I'm pretty much everywhere. It's hard to miss me.
Yeah, love it. Love it. Okay, cool. Well, thank you so much for sharing your insights today. This was awesome. I loved it. If you're listening in, welcome back to the Passive Income Playbook. We're here every Thursday, so join us. If you love this episode, leave us a review, and please catch us next time. And thank you for being with us, Mauricio.
Thanks for having me. It was great.